Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and it is time for another Sifting Stocks Quickly video. I just checked, it's been 3 months since I made one of these, and my goal was to make one every month, so I'm certainly behind. I will put this one on the playlist that I started. I think this will be maybe the 4th installment. So the goal of this is to show everybody how I sift through stocks quickly using fast graphs that I've never necessarily looked at before. If I just have a list of stocks or I'm looking through an exchange or whatever. In this case, I'm going to be going through the S&P midcap 400. I chose the midcap 400 because it has a good mix of lower quality, higher quality, decent growth of different types of stocks, whereas the S&P 500 is disproportionately higher quality, and like an S&P 600 or a Russell 2000, like probably 80 or 90% of those stocks are not going to meet any of my basic kind of standards that I'm looking for. So this is one that has a pretty good mix where I think I can show everybody kind of the different types of things that I'm looking at. The first, I'm gonna go through these one by one using fast graphs, and I have a 25% off affiliate link down in the description for fast graphs. So one of the more useful things that I've used fast graphs for, which is right here, is sifting through lots of stocks, because I don't want to rely on the media to highlight potential investment opportunities, because usually those are things that are kind of being hyped or at least are particularly popular right now at any given time. And those are not usually the best deals. Usually the best deals are the ones that people are not talking about, either because something, kind of bad has happened, or because they just haven't been discovered yet, or people have just kind of forgot paying attention to them. So I like to be able to go through sometimes one by one, which I've done this for all these stocks. I mean, thousands of them. But you'll be able to see how I do it quickly. So I have basically 5 investment strategies, different types of investment strategies. Probably 3 of them are the main ones that represent the vast majority of stocks that I buy. The 2 that I don't use very much are my REIT strategy. I think I only have 1 REIT stock right now, even though I'm willing to hold like 10, because they're kind of the whole industry's in a down cycle, basically. So they have their own kind of category. And then even within that, there's only certain REITs that I'm interested in. Also, the other strategy I don't end up using too much is the dividend strategy. There can be times where a dividend valuation is one of the better ways to go about valuing a stock, but there's a ton of overlap with my earnings-based strategy, which is kind of my main strategy. So it's not too often there's a truly dividend stock that isn't that's good, that isn't a good earnings based stock too. But every now and then they come up, or sometimes earnings are just a little wonky sometimes, and you can use the dividend as it's a little steadier to kind of get a valuation for one. So I use that sometimes too. But the 3 that are going to by far be the most common ones that I use are what I call the full cycle strategy. That's an earnings and earnings growth based strategy. I made a ton of videos here on YouTube using it. It's really just like growth at a reasonable price is what I'm looking for that strategy. The other one is deep cyclicals. This is how I got my start writing about investing back in 2015. It's the first strategy that I developed to buy deep cyclical businesses. And that's the second category. And the third one is the category I use for fast growth businesses. These will be younger companies usually, or at least some that have good growth and really 20% earnings growth or higher, like fast growth. This strategy is exclusive to the full Cyclical Investors Club service over on Seeking Alpha. If you join any of my paid Patreon tiers, you can get a big discount if you ever decide to join the service over there. So definitely join one of the Patreons first and get that discount, and then you can just talk to me and ask me if you have any questions, and we'll get you set up over there if you want to do that. But that fast growth strategy is exclusive to the full Cyclical Investors Club service. But I'll tell you the stocks that I see that look like they'll fit if I run into them in this analysis. So those are my 5 kind of things that I'm looking for. Now, there's usually 3 big reasons why a stock won't fit into any of those categories. The first one is there's not enough data. Pretty much all of my strategies require at least 2 years of data. That's the fast growth strategy. And most of them require, well, the full cycle strategy ideally requires a full cycle, economic cycles or the data, but we haven't had a real downturn since 2008. So it gets a little tougher there. And then I'm willing to make a few exceptions because it's just so long ago. Some businesses haven't even been public that long. And then the other one is, what was I doing? Not enough data. Yeah. So those were, I did the deep cyclical strategy requires 2 down cycles. So it requires a lot of historical data as well. Next, we have, that was the no data reason why they might not be included. The next one is they're just too hard. Maybe earnings fluctuate a lot, or every now and then they'll have unexpected downturns, or there'll be certain risks that kind of make it difficult to use historical earnings. Pharma companies, construction and engineering companies, sometimes insurance companies, consumer finance. If they're lending money, it's hard to know what those risks are. Doesn't mean I never buy any of these type of stocks, but a lot of times I just put them in the too hard category. Like I don't really know what the risks are sometimes. And the last reason is they aren't high enough quality. I really want earnings for all of the companies I buy to be growing at a rate that's higher than inflation historically. The cyclicals can be a little tricky sometimes with that because they go up and down. But in general, like if we just look at Fortune brands here, we want to see rising earnings per share, which is this green area here. If we don't see that, if there's basically they're not making money or very much money, or they used to and they don't anymore, like I'm just not interested in that. The reason I want to own stocks is because they're a financial asset that has the ability to pass on future inflation, even if we don't know what the future inflation is going to be. That's one of the reasons why I want to own stocks. So if a business can't do that or doesn't have a history of doing it, then I don't really want to own it. I want to find the ones that do. This rules out some like deep value type stuff, turnarounds, if it's a real fundamentally business type turnaround. So a lot of times I'll rule those out. They won't even be considered. So that brings us to, I'm going to go run through, I usually do about 30 of these, and I think I'm to letter F for tickers in this midcap 400. I'm going to do F, and I think I did D and E last time. So this will be F and G. I quickly look through it. I think there's about 36 of these. I should be able to get through these in like 30 minutes. And I'll look at them, I'll tell you what I think, and I'll categorize them into either one of the 3 reasons that I wouldn't be interested in looking at them more deeply, or one of my 5 strategies. So there's kind of 8 different ways that each one of these can come down. And I think with that, we'll get started, and we'll start with Fortune Brands, FBIN. So, Fortune Brands, I have this maxed out here. So they've only been public since 2012. That means we don't have Great Recession data for them. It's probably not enough data is what these guys are going to fall into. We can see that while earnings looks pretty good, I mean, we had kind of a COVID bump and come back, but that's not such a big decline deal. But we can tell that the market treats this like a very cyclical business. A 50% drop when kind of the economy slowed down a little bit in 2018. That's what a deep cyclical would do. And then we also have these other big drops in the stock price. So even though the earnings look pretty steady, this is probably a deeply cyclical business. And so we don't have enough data here for a deep cyclical business. So this one's going to go in not enough data. And then I move on. First Cash, FCFS. And we're on to stock number 2, First Cash. I think this is a finance place. Yeah. So this is consumer finance. They also looks like they have some debt. They do have a pretty long history here, but we can see that they aren't really in any kind of a down cycle. They sometimes have these gigantic drawdowns. I would put this, honestly, that's a 50% drawdown. I would put this just in the too hard category because I really don't know what kind of risk these guys are actually taking on. And at least right now, it doesn't look like they're in like a big down cycle, so I'm not really too tempted. It fell over 70% in 2008. That's more than the average stock in the market. So I think I would just put this one in the too hard category for me. All right, FCN. FCN. Okay, so this is interesting. We have a period, well, they were pretty overvalued here, and then we have a period of just real stagnation and decline, some decline. This is research and consulting services. I don't know if they're doing like outsourcing or not. Usually what I check on these guys is see how many employees they have. If they have a lot of employees, that this industry's kind of been beaten down a little bit because of the potential threat of AI. So I don't know enough about what these guys are doing. The PE ratio and growth look okay, but what I would say is it's a little strange that we have this kind of boost in earnings growth, whereas back here we had just total stagnation. I think I'm just going to put this one in the too hard category for now because I'm not sure if we'll get, I don't know if this period here was just kind of unusual, whereas in the rest of the future is going to be more like it was back here. Like this earnings pattern is just kind of not particularly steady. I don't feel too confident that we can predict like the future earnings based on it. So I would put that one in the too hard category. Let's see, FFIN. That one was colored red, so I don't know if that's just because it's not. Okay, we got a bank. I think so, yeah. So a regional bank. These usually trade pretty similarly with other regional banks. So I always try to find the ones that are like the highest quality. This one looks okay. Yeah, I think I just put this one in the full cycle strategy. And I probably do actually already track this one. I think I recognize the ticker. And so I would just do a normal earnings-based valuation. My guess is that a 24 PE is going to be way too much to pay for a regional bank, but you know, maybe you could have picked it up, you know, when it was down here at a more reasonable valuation, depending on, you know, what the quality and everything looked like. But it looks okay. I could value that, I think, at least try. Similarly to other banks. Five Below. So Five Below, I know I've looked at it before. This is pretty unusual. So we have this growth. I tracked this, I think, as a fast growth business. This is a COVID kind of related decline. But the problem is we have this would have fit my fast growth strategy. But what we have here is earnings have basically topped out and they're declining actually this year. So it could be, you know, this is just too late stage going public, and their growth came really quickly in like within less than 10 years, like 8 years. And they got to where they maybe have difficulty growing bigger, even though they're only $5 billion. And so once this growth stops and the market realizes it, you can get these giant declines, you know, where they go from a 44 PE, fall 55%. So this is transitioning from a fast growth business to kind of a slower growth business. And I would say what I see right now with earnings, like in the past 4 years, it's not high enough quality for me. And it doesn't really fit my strategies. But right so far, the past 3 years, this growth rate is not good enough for me. And it doesn't look like, it looks like we're going to get another year where we'll have a 5-year period with no growth. So I don't want that. So probably not high enough quality unless things change. You know, you can keep an eye on it and check back in at some point. Fix. So, this is a very interesting one. Okay, so we have this. Let's shorten the fast graph before we get into what's happening now. Let's see what they do first. Okay, construction engineering. So the problem here is that construction and engineering is just too hard. And you can see why if we go back in time. we have these years with 113, 32, 56, 13, 57 growth. The growth looks fantastic. And then growth just gets killed, basically. And the problem with most construction engineering companies is that they bid things out, and then if the costs come in higher than expected, then they can go from like what we see now. So this looks like a beautiful graph of earnings growth, right? Almost similar to going into 2008. And people that bought this stock have done fantastically well, up, call it 2,000%, right? But much like going into 2008, and I don't know if this is going to be a peak or not, just because they've had this level of earnings growth the past several years it could literally end the next year and have 4 years of declines, and then you lose. I mean, I bet the stock price fell a lot back in 2008. Let's go check. Maybe not as much as I thought, though. Let's see. So we have a 50%. Is probably a little deeper than that from peak to trough. Maybe up here even it was a little bit higher before and it looks like it did bottom down here. That's about the same. So it probably fell about 60%, about the same as market. That's not too bad, really. But you can see that earnings went from being fantastic to not being fantastic really quickly. And, if you did buy back here and you held for, let's see, that was 2006, even if you held it for like 10 years, give or take, you only would have had like a 7% annual return. So if you do want to buy one of these, I think you want to buy it when things are bad. But I've had them, not this particular company, but I've had these type of businesses go bankrupt on me. So it's really hard to know like what the liabilities down the road can be. Usually people see the new business that's going to come in and the backlog, but we don't know how much it's going to cost the construction and engineering companies sometimes to fulfill those commitments. And so it's really, really difficult to use historical earnings to help guide the future. So I'm going to put this one in the too hard category, even though it's looking pretty good right now. This is let me see what the market cap. I'm going to go on a slight tangent here. Yeah, 13. I wouldn't be surprised if the S&P 500 puts this in soon. That's just kind of the thing that they seem to want to do lately. So it'll be interesting to see what happens with that one. Okay, Foot Locker. Foot Locker, I think we know. Retailer, shoes. Pretty good run up until 2017, but we can see that earnings, even though they've been super choppy, are basically declining. This is not high enough quality for me. I want it to be like it was back here. Or even this would be a deep cyclical looking at what they did during 2008. So it wouldn't even be an earnings-based thing. It would be a cyclical-based thing. And, you'd have to have confidence they could get back up here to where they were. It's hard to know. It doesn't mean they can't do it, but not high enough quality for me. So Floor, FLR. Very similar type of a thing. Much better earnings. This is probably related to, it's another construction. This might be a good example of the construction engineering problem. So things look great from 2004 to, even all the way up to 2012, 2014. So 10-year run, 15% CAGR. That's wonderful. That's what you want to keep going. And then all of a sudden, earnings growth falls off a cliff, then really falls off a cliff. Now they're trying to come back. You can just see how unpredictable these are. So I'm going to say that this one's too hard. FLS. So Flowserve. All right, so this is kind of similar, actually. Earnings and stock price peaked in 2014 and decline. We do have earnings rising again, but the problem is like all this history here, which is what I try to rely on, it doesn't really tell me anything about what's going to happen in the future. So this is another one that goes in the too hard category. Who knows what's going to happen, 2 to 5 years from now, which is what I'm kind of aiming for. Which one was that one? Flowserve, FLS. That was Flowserve. FN. Fabrinet. Okay, so this is a little easier. We do have a drawdown in 2012. We don't have recession data from 2008, but overall earnings growth is rising really nicely. Probably looking to rise, in the low teens, it looks like here going forward. So that's all good. We have a decent PE ratio. So I'm not doing a valuation here. I just want to know if it's something that I could value. This one definitely looks like it is, even though I don't have a real recession data. It's pretty decent. So I'm going to put this one in the full cycle category, and can maybe find some peers of theirs and see if, now they are electronic manufacturing. This can be a cyclical industry, but you could look at some peers, and if they have data from 2008, maybe you can go back and see how cyclical they were, and then help use that as a guide for what to expect in terms of cyclicality. But other than that, that looks like a solid full cycle strategy business. Pretty sure I tracked that one. FNB. Is this US? Okay. So again, if this is a financial company, yeah. Regional bank. Okay, we had higher earnings. We're just now recovering earnings from 2005. The stock price has never recovered. That's not high enough quality for me. I really am very judgmental with the banks when it comes to how they performed during the 2008 decline. And I don't want any that perform badly, which sounds harsh, but there's plenty of regional banks that did fine. I've owned plenty of regional banks, so I'm not missing out on too much by just immediately ruling out the ones that I don't, that have a history of, having problems, not lending well, losing money. Not always everybody's fault, but sorry, I want the ones that did well. Okay, so similar thing here. This one, there's not really enough data, and two, this looks like a very cyclical business with floor and decor. We already see it's kind of in decline with interest rates being up. I'm going to put this in the not enough data category. It's probably going to be cyclical longer term if we get more data over time. FNF. So this stock I actually warned people about. I've written on this one before. I warned people about this earnings decline that we're seeing here because things were so bad in 2008. They did buy what did they buy? Some kind of insurance or annuity company, I forget, just recently. So they're a little bit different business, but they do title insurance. And I predicted this earnings decline here. The stock did fall, but now it's rallied it back pretty hard. To me, I thought there was a lot more risk to the downside here, so I was kind of warning people about that. And right now it's bucking that trend. But we'll see if these earnings, this earnings recovery that's kind of starting to happen, we'll see if it has legs up or if it continues down over time. But earnings definitely did return back to pre-pandemic levels, which was kind of the main thing I was thinking of. I think this one's actually too hard because it's just hard to know, what this business is actually going to do. Although the bulls who own this stock were happy to tell me that I was wrong and that they knew what was going to happen. So far we both kind of been right, but at the current time they've been more right than me because the stock has bounced way back. Okay, Fossil Group, FOSL. So this is not enough quality. I think it's pretty obvious just by looking at the earnings. They fell. Maybe they'll come back someday. That's not something I want to even touch. Fox Factory. I've made videos on these guys before here, I think. If not, I did them for Patreon. I can't remember if they're in the S&P 500 or not. Or they're obviously in the S&P 400. But they might have been in the S&P 500 and then the stock price fell so much that they got downgraded. I can't remember. But so this is a cyclical business. This is what's going to happen. So this is why we want a lot of historical data to categorize a stock properly. Earnings growth looked absolutely beautiful here. The valuation was nuts, but it came back down. But the problem is now we're in a downturn, and earnings have fallen oh my gosh, they went from 550 to 3/4 or something from the peak, and they're continuing. We don't know where this bottom is going to be. Well, if we had historical data that went back to 2008, we could go back and look at how far this could potentially fall, right? But we don't have that data, so there's no way to really know. So I'm going to call this one as not enough data at this point, but we know it's going to be deep cyclical as long as they survive and bounce back eventually. All right, FR, First Industrial Realty Trust. That is going to be a REIT, I'm pretty sure, but I'll look at it just to make sure. Usually on the fast graph, if you pull up, whoops, wrong ticker. FR, not FN, Corey. So usually with the REITs, you'll see this will come up as like these adjusted, I don't know if this is free cash flow adjusted metric, but it'll have a different metric that pulls up, and then it says Realty Trust. So this will go into the REIT category, and there is enough history here. We see that they got totally creamed in 2008, which makes me a little cautious on them, but they have kind of fully recovered. So I'll put this in my REIT. I'll put this in my REIT category. We have the data there to look at. It might be okay. All right. So First Solar, FSLR. So this one I own, and it's kind of a bit of an oddball because normally I would put this in too hard category or not enough quality category, but I think that we may be in like a new kind of upcycle, a new secular growth phase for these guys, due to the fact that they're one of the only solar companies that's like for industrial and solar panels that doesn't manufacture in China. So I think it has kind of some unique properties that I liked, and I could end up being wrong. So normally I would put this in the probably not high enough quality or too hard categories, but I actually value this one as a full cycle and just use a 10% earnings growth assumption. So we'll see how this one goes. Sometimes I have one or two stocks that I picked that are outside of my strategies. It doesn't happen very often, but sometimes I'm tempted around the edges to find things. FTR. Nope. FTR. Frontier Communications. That one might be gone now. It's not pulling up. I don't see Frontier. Okay, so we'll forget that one. Let's see what else we have. FYBR. FYBR. Oh, maybe they changed it. Parent company. Okay. Yeah, not enough data for these guys right out the bat. Genpact. I think these guys are insurance. Let's see. Oh, no. Data processing. This is the one where I think AI, and this is why you're seeing I'm getting like really creamed here. Probably AI could be a threat. That's what the economy or what the market thinks to their business. So I would put this one in the too hard category for now. And then there's not quite enough data. We didn't really get to see what happened back in 2008. And we do know, from the 2020 crash, that the market's willing to just send this stock down deeply. Let's look how far it was. Yeah, so it probably went down 50% in a month back then. So yeah, just not enough, too hard, not enough data, whatever you want to pick there. Glacier Bancorp, this looks like another regional bank. GBCI. So they got hit pretty hard here. This would be a deep cyclical. It looks like it's happening again. So you could probably treat this as this is kind of a weird peak, but you could probably put this in a deep cyclical category if it was down. Yeah, it looks like 70% off its high or something. Similar kind of a peak, super peak here. And we're down, like if this keeps going or whatever, could easily get down there. But I'll put that in a deep cyclical category. It'd be on the weaker end of high quality, but you can see, look, earnings growth came back from 2008. So did the stock price. So they recovered pretty well, and that's what you want in a deep cyclical business. So I would be willing to look more into that one. And if it was down like 70% or something, you might be able to take a stab at it. GDDY. Go daddy. Okay, so got hurt during COVID. This giant jump recently, like to me, this is just too hard. You could say, well, yeah, I'd put it in too hard more than not enough data, because this is just kind of a weird history, is what I'd say. What little history we have. Let's see, green dot, GDOT. I don't think I've looked at this one before. See, it's good to go through here. Even me, who I've looked through tons of these stocks. So this is not going to be high enough quality for me. They had an earnings growth bump, but now we're on a totally down earnings trend. What are these guys? Yeah, consumer finance. I wouldn't touch this one. Geo. I think this is a prison REIT, if I remember. At least it used to be. So let's see. Security and alarm systems. Maybe they changed this up a little bit. Yeah, at any rate, it's not high enough quality for me. Let's see. GLPI, Gaming and Leisure Properties. Now, in general, I don't invest in casinos and casino-related stuff. This looks like a REIT that's probably related to casinos, or something along that, or some sort of entertainment facility, potentially, you know, like a concert hall type of thing. I may have looked at these guys before. I would put these in the too hard category. It's just kind of really hard to know what kind of risks they're taking with that type of stuff. GameStop. It's still in here. Let's see. Okay. They started losing a bunch of money. The stock market went crazy. Looks like they may have had a little bit of a profit again. This one's going to not be high enough quality for me because I care about earnings. All right. Let's see. GMed. I feel like I've looked at this one before too. So yeah, this is pretty interesting as like a full cycle stock, but we don't have a real recession data. What do they do? Healthcare equipment. Yeah, we can do a full cycle. Put this in the full cycle category, and then we'll just have to we'll have to do a little bit deeper research to see what a down cycle might do to them, look at what they actually do and so forth. But it's worth looking at as a full cycle stock, I think. What do we do? Generac. I think I made a video on these. For every, I know I did on the YouTube channel actually, because it had this gigantic crazy run up. Sometimes the market just does crazy stuff, and then it's a cyclical business, and they got hammered when the cycle started coming down. Now it's jumping up a little bit. I think probably these recent hurricanes helped. So yeah, it's up about 20%. So this is going to be a deep cyclical business that doesn't have enough data. So I'm going to just say not enough data, because I want to see what they did in 2008, what they did during a real down cycle, just how bad can these down cycles get. That's the type of thing I want to see to try to figure out when to buy it. GNW. I think this is insurance, maybe. Again, bank. Yep, life insurance. This looks horrible. So not enough quality. Done. Next. GO, grocery outlet. Never heard of this. Not enough data. Next. Graphic packaging. GPK. Okay, so this is interesting. This is pretty hard. So we have like a boom here. We're having the bust now. We have a packaging company that would normally be like a full cycle company, but I'm going to put not enough data because we have the data here, but they weren't earning, like from back before 2008, but they weren't earning any money yet. So I don't really know what it would be like in a downturn. We have some evidence here. Maybe this is just M&A or something. I'm not sure, that they could lose, earnings growth could decline. And then we have this boom bust problem here. So too hard, I think, is what we're going to do for this one for now. In the future, if I get to see what they do in a downturn and figure that out, then I might come back to it. Gap, GPS, these guys they're like a clothing outlet or a clothing store. Why isn't it? Maybe they got bought out or something. I don't know what the deal is. Let me just see. GAP. Oh. Let's see what this says. Maybe you have a different ticker. Retail? Yeah, apparel retail. Okay. So this is not enough quality. Earnings peaked back here. The price peaked back there. Haven't yet recovered those highs. Let me double check and make sure that I picked the right. Okay, it says Gap, but it has a different ticker. All right. Grubhub, GRUB. Why is it bringing up all this stuff? All right, I'm not getting Grubhub. Maybe they got bought out too. Next, GT, Goodyear, and hopefully this one will find the stock. There we go. Yay. I think I made a video on this one. So this is a deep cyclical. We have a recovery, at least up through 2016. Then we have this other downturn where they have not recovered from. So to me, this is not high enough quality probably anymore. That's what I'm going to categorize it as. Sometimes these can come back. Maybe you can use this little peak here as a marker and as a guide instead of going all the way back here. But with all the stimulus money and everything, these guys probably have a decent amount of debt. Oh, they have a ton of it. Yeah, that's just not high enough quality. Okay. Let's see, GTLS. Looks like I only have one more after this. GTLS. Chart Industries. Haven't heard of this one. This looks cyclical. Very cyclical, actually. And earnings never came back like super strong until the stimulus boom. What do these guys do? Industrial machinery. Quite a bit of debt. I'll put this in the deep cyclical category. It's pretty borderline in terms of quality at first glance, but there might be a situation where I'd be tempted to buy it if I could get it super cheap. GXO. I think these guys, I know these are the logistics because it just said so, but I don't think they've been public. Yeah. So these guys got spun off, I think, of a different company. We don't see much earnings growth here yet, so this just isn't enough data. All right, and I think that's the last one. Yeah, I did F and G. Okay, so that's it. Let's see how many we have total. 5, 10, 15, 20, 25, 27, 31, 33, 35 total. So 35 stocks. Not sure how long this video has been running now. Here's how it broke down. Only, let's see, 7 of the stocks fit my strategies out of the 35. So 4 of them would have fit full cycle strategy, 2 would have fit deep cyclical strategy, 1 would have fit the REIT strategy. It's possible there could have been a couple if I looked more closely that might have fit my fast growth strategy, but none of them jumped out at me because I keep a pretty sharp eye on those stocks, and none of them I don't think actually do fit out of this group that I can remember. So that's, what is it, 1/5 of the stock. Only 1/5 of these are worth kind of deeper research, tracking, seeing if I'd be interested in buying them. The rest are either not enough data, too hard, or not enough quality. So those broke down almost equally. There were 8 that didn't have enough data. There were 9 that were too hard, and there were 10 that were not high enough quality. So pretty equally split pretty much among those categories. And only a handful of them would be worth me spending like more time on. So this is kind of where it's really important to have sometimes. It doesn't have to be fast graphs. I think it's really useful in these initial stages and also for earnings-based analysis. You just see, look, how cyclical are earnings? How much data is there? How long they've been in business? Is it dependable? Are the earnings dependable? How does the market treat the stock price relative to what earnings are doing? You can literally see all that in 10 seconds. So, and then once you do like hundreds of them like I have, and it goes pretty quickly. Like you kind of know what you're looking for, and so this is how I sift through stocks, and I'll make a list of the ones that fit my strategies. Usually I do a little bit more research, and then I'll put them in my spreadsheets that you've seen me use on the channel, and I'll track those, and I'll run some more numbers on them. Sometimes I'll put a buy price on them if everything looks good except for the price, and then I'll be ready if those prices hit. I monitor like 700 of these, then I buy them. I can buy them even if nobody else is maybe paying attention to them, or not as many people are paying attention to them, because I looked them up myself. I didn't rely on CNBC or whatever, the other Kramer guy to tell me what I should be buying. I figure that stuff out myself ahead of time, and I don't have to get influenced by the media to find out what I need to be potentially adding to my portfolio, or even just tracking to maybe add at some point. All right, if you found this useful, hit the subscribe button. I'm going to put this back on the playlist with the other ones that are other videos where I did exactly the same thing. Hopefully I'll put one of these out a month. I was a little slow on this one, and we'll get through the rest of the entire mid-cap index. And you can see it doesn't take a ton of time, about a minute per stock on the initial thing, and then you will winnow it down to the best ones that might fit kind of what I'm trying to do. Thanks for watching. I'll see everybody later.